Hey everyone, welcome back to NAAIM Confidential. This week we have John McClure, a fund manager, or not fund manager, but I don't know, John, how would you describe yourself?
Or an institutional asset manager.
Institutional asset manager. There you go. I like that, John. John's an interesting guy. He's one of the more interesting guys you can talk to about this stuff because he has an incredible sense of humor and always comes up with a saying that cracks me up. So John, a lot of crazy stuff going on this week. NAAIM Exposure Index, which is our own sentiment indicator at NAAIM. It's a survey compilation of active investment managers, and it measures their exposure to equities as an average. So we're at 88.99. So almost 90% exposed on average as active managers currently. And we have, the S&P 500 closing at an all-time high, NASDAQ 100 closing at an all-time high, ton of momentum in the market, VIX down at 13. What's going on in your world? What are you seeing? What's your thought about, the markets and the current environment?
I had an interesting comment the other day from somebody that I know that was saying, man, you must be really doing really well in the markets. They're just taking off like a rocket ship. And I said, yeah, it's been pretty good. And he said, boy, it's just been crazy. I said, well, when you say crazy, what are you referring to? And they said, oh, well, Bitcoin, it's almost at a new high. And I'm like, it reminded me back when in 2006, I was very fortunate, looking at a lot of data. I needed to sell my house because we just had our second child, and the guy that was doing our yard work quit to start flipping houses. And I was like, okay, that was the sign I was looking for, And I sold my house in May of 2006. It's probably the best call in my life, right before the real estate market. So here I get this comment about, Bitcoin. This just happened like 2 days ago. Oh, and now you're talking about the NAAIM index. Yeah, there's a lot of froth out there. But, as a risk manager like I am, I've predicted, 10 out of the last 2 bear markets, right? I'm always nervous about, the cliff around the corner. So I have to kind of talk myself off a cliff and stay invested and reap those profits as long as I can. But it's undeniable. It's frothy. There's no doubt about it.
Well, how do you define froth? What is that? What does that mean to you? A lot of people will talk about, forward earnings are, make it actually not that overvalued, or some people say if you look at like Schiller PE, it's way overvalued. Just help us define froth. What does that mean to you, John?
It's priced to what I'd call perfection, right? I mean, if there's, it's at a high multiple. If you get bumps in the road, the drawbacks are going to be pretty extreme. I think everybody's trying to figure out how AI is going to, it should make us a hell of a lot more productive, and productivity drives down inflation and puts more dollars in everybody's pockets. And I know we use it in our shop with success. My brother's also a data scientist, and he talks about how they use it on the programming aspect of things. I think it improves the productivity of programmers by, it's crazy. It's like it makes them 2 to 3 times more productive in the way that they can write code. So how that propagates throughout the markets, and is that what the market's pricing in? How many times has a market taken off and left you, and you just, you're scratching your head trying to figure out why that's the case? It's generally my fault not figuring out why it was the case. You know what I mean? So markets are moving, and we're moving with them, and but I'm always nervous, always.
Yeah, I mean, does that come back to where you talk about, we talk about efficient market hypothesis, right? And price is a summation of all information at all times, right? So is the market knows, or all the participants of the market as a collective, right, knows the productivity of AI, and thus they're currently pricing that in. And so what you're saying is you feel like the market, might have taken off, and if it leaves you behind, it's your fault for not figuring out kind of what the rest of the market figured out, not necessarily that the market's wrong.
Correct.
Or are you saying that? Okay.
Yeah.
I mean, I think that's why they, price and momentum. I'm a technicals guy, right? I like looking at a lot of technicals, and I kind of feel that way. Where do you think like the froth would maybe rear its head, right? Like, where can you identify froth, or identify weakness in the market, or is something that would lead you to believe like, hey, there's a lot of underlying risk that could rear its head, or is it just momentum's taken off and get on board or get left behind?
Well, you got to go with the ride. I mean, it's you don't want to step aside when it's just moving higher and higher and higher. But I mean, I'm one of the believers that inflation's here to stay. The cost of labor in China today is like 9 times higher than it was in the 90s.
Yeah.
So I mean, that was a real deflationary thing for the world. Is the way China deflated the market, and everybody went to China to buy their stuff. So now you've got reshoring going on, and it's really growing. So you've got manufacturing, people building plants all over, which is one, that's inflationary by itself.
Mm-hmm.
2, it's inflationary because goods are going to cost more because you're not buying as many of those goods from quote China and other places. I mean, I'm not an expert on this, but there is inflationary pressures today that we haven't had, and how that's going to play out in the markets and how to adjust to it, I don't know. It's going to be interesting to see.
Yeah, I remember. Do you remember being at NAAIM Outlook in 2022, and Joseph Wang was there? He's got the handle FedGuy12 and like FedGuy.com, I think.
Been reading Joseph for a while. He's generally one of the smartest guys.
Yeah. So he do you remember though when he started his presentation, he said, okay, everyone keeps saying it's going to be, higher for longer. That's the narrative. And he said, I think they're wrong. And, that always catches some attention. He goes, it's higher forever. And I was like, oh my gosh. And what he kind of had summed up is what you were saying, which is basically China came into the WTO in the early 2000s and brought all of this, cheap labor with them. And it had this massive disinflationary effect or deflationary effect that offset what should have been the inflationary effect of the monetary policy, that Fed has implemented over the last couple of decades. And that relationship fundamentally changed with COVID. And that's what you're saying now is labor is, how many times more did you say it was? 5 times more expensive?
Not 9 times.
9 times more expensive to have, labor out of China. So that's, if you have the same monetary policy, but, now labor is 9 times more expensive, I think that presents a case for inflation to be around. But maybe the next question then is AI the next disinflationary effect that could offset that inflationary effect?
That's exactly it. Yes, it could be the great offset, right?
Yeah.
Because productivity is what drives down inflation and puts more dollars in everybody's pockets.
So there's froth out there, but the froth could really be, forming on top of a really nice cup of coffee that people might not want to pass up on.
Yes.
So how does somebody participate if there's a lot of froth out there and there's a lot of uncertainty? How does somebody participate, John, without taking all the risk of spilling their milk, so to speak?
Depends on who the investor is and what they're trying to accomplish. I mean, if they're dealing with a money manager that helps to manage that risk, then they can put their money with said manager and hopefully sleep good at night. Someone who's concerned with managing the risk. If they want to do it on their own, there's, these ETFs that, buffered ETFs that have options that limit the amount of downside you're willing to take. On the retail side, everybody chases the market. They can't stand it when the market's up 30 and they're up 10 or 12 or 15. But if they've been financially planned correctly, and they know that they need to average X% a year to achieve their goal at age whatever, they should really not care what the market's doing, and they should only care if they are on their plan to accomplish what they have set out to do. Because when you start chasing things, that's when you really get in trouble, right? When you're chasing after stuff with no risk controls in place, that's when you get cut in half, and it's no fun.
Yeah, when people start letting behavioral tendencies and biases drive the bus, it's easy to drive around the cliff.
The only thing more emotional than making and losing money in the equity markets is making and losing lots of money in the equity markets. So,
yeah, well, I always love your sayings, John. That's probably the least colorful one I've heard from you, but memorable nonetheless. So what, what's your take on, you look at like the inversion of the yield curve at all, and what the bond market's pricing in or anything like that when you're, looking at what you call froth out there or uncertainty in the markets, and you're trying to understand the dynamics, or is the yield curve anything you pay attention to?
We don't use the yield curve. I mean, we're a data science organization, so my elevator pitch is that we turn data into information, and then we convert that information into dollars by trading financial assets for our clients, right? And so we look at all kinds of data that have edges, and then we try to harvest those edges. And but the yield curve is not one of those edges that we use.
What is there any particular edge that you do look at that you care to share with us or expand upon, or?
Yeah, I mean, it's been an evolving process for us, but we trade the market by the state of the market, and so there's three states. There's the low volatility state, and then there's the high volatility state, and then there's this middle state in the ground. We call that the neutral state. There's a lot of information in high vol, and there's a lot of information in low vol, and so those tend to be pretty productive markets for us. But the neutral state doesn't have as much information, and occasionally I have to remove sharp objects out of my office when we're in that state to trade that market. But when you're in a low vol state, you really can't trade a market like that. You want to grab the beta and you want to go, right? Because the market's giving you a free ride. And when you're in a high vol state, I mean, think about margin calls and all the weird stuff that happens when volatility spikes. The markets become very inefficient, right? I mean, if a market swings up 4% today and down 4% tomorrow, an 8% swing in price, which is very common. I mean, think back in March of 2022 or 2020, that's not efficient, right? Because people are having to sell what they have to versus what they want to. And so our trading style changes and fluctuates by these volatility states that we're in. We're in a low volatility state right now. We've been in that state since the markets bottomed out in the fall of last year. And so we're trying to capture all the beta that we can. I mean, in a nervous fashion, but we never know where the cliff is at. We have to manage that risk, but we're definitely in a low volatility state right now, for sure.
How do you define a low volatility versus high volatility or neutral volatility state? What does that mean to you guys when you're computing that back to data science and information?
Great question. We don't look at the VIX at all. And VIX is implied volatility. Let's look at the options contracts. The VIX is kind of messed up right now. The CBOE is scrambling. They've launched new VIX VIXs. I don't know if you're aware of that, because these 0-day options are now like 50% of the market, right? And those aren't captured in the traditional VIX. And I mean, like the VIX didn't act like the VIX last year in 2022. It didn't. I mean, it should have spiked a lot higher. It didn't spike, and a lot of people think it's a 0-day options. I don't know, but we look at we're looking at the realized vol, right? I mean, there's some math to it, but I mean, if it's raining outside, you're going to take an umbrella. So
Sure.
It's easy to spot when you see it, and we like to get ahead of it a little bit, but we're looking at realized volatility.
Is there when you talk about realized volatility, what I'm thinking is just like you said with the VIX, it's the implied volatility of the options contracts, right? Which accounts for both, realistically accounts for both the up and down, right? Because you have the put call parity. So it's implied volatility theoretically in either direction. But that's going to be quite different than realized volatility, like you're saying, right? So realized volatility being more akin to, what's the weather, like the weather rock, right? If it's wet, it's raining outside. So when we observe volatility, like how do you observe volatility? Is that looking at an index and its movement in price range over a number of periods? Is it looking at different ratios and the way different sectors are moving together or away from each other? How do you observe the volatility as it happens?
Well, I'll tell you one of the unique pieces of information we use. We look in the corporate bond market. It's
okay.
Only 10% of the bonds trade on any given day, right? So there's not a lot of efficiency. And so if you're going to move around large amounts of money in an inefficient market that doesn't trade a lot, you're going to pay dearly in transaction costs, right? The bid-ask spread's going to get wide. And so we've identified a footprint with the way money moves around in an inefficient market that gives us a tell on changes that are happening in the marketplace, which is very predictive of changes in volatility that's coming our way. So that's one of the things that we do. I mean, you mentioned, how offensive and defensive assets are reacting. That's another piece of information we do. So we're not looking at an index and taking a standard deviation of that index and saying, okay, well, the volatility is doing this. We're looking at the internals of the market, if you would, that's giving us a deeper understanding about the dynamics of the market that are changing to help us better anticipate, if you would, the expansion of volatility. I mean, there's a lot of white papers out there, RSA. I mean, there's several white papers that will tell you that it's a hell of a lot easier to predict changes in volatility than it is to predict changes in price. And we would argue that if you can successfully, get ahead of changes in volatility, it makes it a hell of a lot easier to predict changes in price, right? So we spent a lot of time on the volatility part of the equation because it makes the rest of our job a lot easier.
Well, I think what you do with that information too is to largely depend on what your objective is, right? Because if your objective is stability in a portfolio, you may do the opposite with incoming volatility than if your objective is, speculation and, growth at all costs or whatever, right? One of the things you've said in the past that was really impactful to me was one time when you said volatility is leverage, and I think about that all the time. Every time I'm looking at the different indexes or asset classes, and I'm looking at correlations and beta, and what is, I guess, so as you see volatility incoming, is the concept then to just say, well, I want to keep the same amount of beta exposure in a portfolio then, so I'm going to reduce my exposure, thus bringing down the volatility, in a sense, deleveraging it, right? So that way, as the volatility is realized, it brings kind of the beta back in line with your anticipated leverage expectations, if you will.
I mean, I can give you some math behind that. So in a low volatility state, the market moves up or down on average. I think it's 55 basis points. So on any given day, market's up 55, it's down. Now averages are deceiving, right? Like today, the market was up, pretty significantly.
Well, yeah, I mean, it goes back to the old, like, you can have your head in the freezer and your feet in the furnace, and on average, you're feeling fine.
That's right.
Right. Yeah.
But as a rate of comparison, the average daily move in low vol is like 55 basis points. The average daily move in high vol is like 137 basis points. So
Okay.
it's over twice and damn near 3 times, right? The
Mhm.
move that you have in high vol versus low vol. And that's where the leverage comes from. Because when you lever something, let's say you lever something 2x, you're going to double whatever the performance of that move is in the market.
Mhm.
Well,
Mhm.
if volatility is, 2.5x what it is in a low vol state, I mean, ultimately that's leverage, right? So if you want to normalize the vol, a very useful math, and almost everybody uses it, is a function called average true range, which takes the
Mhm. Mhm.
the highs and the lows and where it opened and where it closed, and it looks for these big moves. And when that starts to move up, you can proportionally reduce your exposure so that you're not, exposed to crazy times. Now our cutoff is at 200%. So if the market's 200% of normal vol, we start paring back our positions. Like in March of 2020, the average vol was like 475% above average. So
Mhm.
it was, you definitely want to start taking money off the table, i.e. risk, to give yourself the same exposure as in a normal market, right? You have to adjust, but that's what we do. And I'm a CTA, as we discussed, Branden, and pretty much every CTO on the planet does this, right? It's not something unique to us in ProfitScore. It's a way to manage risk in the portfolio.
Yeah. Well, I think that's what active management, in my opinion, always comes back to, right? Is it's not always necessarily about beating the benchmark. It's about managing the risk. For me personally, I know it's oftentimes, if you can manage the risk and you can help your clients achieve their mandates or their goals and objectives, then that's what really counts. And realized volatility in portfolios oftentimes, can be too much emotionally for people to handle, and it can cause them to deviate from their
So Branden, since we're on the topic of risk, I've got a few slides here about the 60/40 portfolio, and
please share.
Can I share you? Let's hopefully this goes as planned here. So
yeah. Oh yeah.
Do you see my screen?
Yeah. Yep.
You see that? You see this 60/40 portfolio screen?
Yep. Yep.
Okay. All right. So this is really simple stuff, right? So in the red line is simply the S&P 500. Okay.
Okay.
And this yellow looking line here is the ag. And the blue line is a 60/40 portfolio where you're 60% allocated to the SPY and 40% allocated to the ag. It doesn't get any simpler. The crazy thing is, if I take like the Vanguard diversified equity and the diversified fixed income to come up with these same numbers, this silly SPY and ag thing actually makes more money and with less risk, just for what it's worth. Now, according to JP Morgan, 82% of all the money is managed in a 60/40 portfolio, right? 82%.
How much did you say? 82%?
82, yeah.
Okay, all right. Okay.
And I asked this to RIAs and money managers I talk to, I'm like, do your clients ever call and complain at you for making money fast? They're going, no, nobody calls about making money. I'm like, they only get upset when you are losing money on the fast side. And they're going, yeah, well, so this bell curve here it's a standard deviation bell curve. So if you take all of the daily moves and prices and, over a large enough period, statistically, all of these prices are going to fit in a bell curve, right? And you got an average. And so you've got what we call left tails, this is the negative side. This is your negative returns, and you have, the right tails, which is the positive side. So in institutional circles, where people focus in on is on the left side, the negative tails. Who really cares about the positive? So instead of standard deviation, a better way to do this is to just look at the downside deviation. So you're only focusing on data points on the left side of this, right? So if you took the downside deviation of the S&P 500, and you take 60% of that number, right? 60-40 portfolio, it's 6.26. And if you take the downside deviation of the ag and you take 40% of that number, it's 1.35. Now, if you blend those two return streams together, then you're gonna your downside deviation of the blended portfolio, right, is going to be 6.98. Now, these numbers don't add across because when you blend, you get the offset. One's losing money, the other one's making money, and so on and so forth. But here's where the math gets a little tricky, right? So if you take this 6.26 number and you divide it by the total number here, right, you get 90%, right? So there's a term used in institutional circles. It's called risk budgets or risk budgeting. So in a 60-40 portfolio, 90% of the risk comes from 60% of the allocation. So
historically.
Yeah. So from a risk budgeting standpoint, it's on its head, right?
Okay.
Normally, you wouldn't want to concentrate that much of your risk in one of the asset classes. And so I ask, money managers, I'm like, so if fixed income had the same volatility as equity investments, would you ever invest in fixed income? And the answer is always no. Why would you invest in fixed income? Because you make more money in equities if it's the same volatility. I'm like, so the reason you invest in fixed income is to offset the equity volatility. And the answer is always yes. I'm like, okay, well, there's other ways to do that, right? I mean, you can use other hedging kind of products that offset that equity volatility. And if you do it with an instrument that makes more money than fixed income, then really good things happen, right? And I'll show you one slide here. I'm not trying to pitch one way or another. And there's a methodology out there called core satellite or core and explore, where instead of taking 60-40, if you took 50% of the money and you put it into equities, and you took 30% of the money and you put it into like the ag, and then you stick 20% into a satellite. Now, in this example, the satellite is our long-short equity thing we do, the PSRA index, right? So if you were to do that, then really good things happen, right? And because you're trying to offset the equity vol, and you're doing it with something that makes more money than fixed income, and you can see the results in the chart, right? So the green is the ProfitScore index, the blue is the 60-40, and by just changing your allocation just a little bit, you make more money and you take less risk, right? You lower the risk. Right now, I'm using the PSRA index as a proxy here, but you can use other instruments as well, right?
Sure.
What I'm trying to get across is the 60-40 portfolio is upside down from a risk budgeting standpoint. It's putting way too much risk in the equity basket. And And the fixed income, I mean, as you saw in 2022, right? I mean, that was a difficult market for people because the correlation of equities and bonds, joined the party, and net of inflation. If you take a net of inflation on a blended 64 portfolio on 2022, which you got to subtract like another 8.5%, that was a worse performance than 2008, because in 2008 bonds, got a lift, right? And there was no inflation in 08. So it's just a slightly different way to accomplish what you're trying to accomplish and take less risk. So I need to stop sharing my screen with you. And
I was just going to say, it takes me back to the old saying, if you manage a downside, or I think that's how that goes. If you manage a downside, the returns take care of themselves, right?
Yes.
If you manage a risk, the returns sort of come. There's that fundamental kind of upward bias tailwind to the market. So if you manage a risk, the returns, it can kind of just come in. The trick is keeping the returns, right?
I mean, if 82% of the money's being managed in 60/40, which you and I don't think this way, right? I mean, but if the average advisors listen to this, I'm just my word I'm saying is that you don't have to change it very much, right? You just do a slight change in your allocation, and it can have significant impact on both the increasing returns and improving the risk profile for investors. So
I think that's where risk profile matters, and everyone talks about return, and people so often forget to talk about the risk profile of everything. And at the end of the day, that's really what drives everything, because if you have to give it all back, it doesn't really matter what the return was to begin with. So, right.
Correct.
And that's at least how I think. I think a lot of good managers think similarly. I think that's what I've learned from a lot of good managers. Cool. Well, I appreciate you hopping on, John. We're happy to have you as a member of NAAIM. You're a great value add to the organization. And anyone out there that's listening, is an advisor or a planner or another institutional money manager, the NAAIM organization has been great, not just for myself, but for a lot of advisors. We have our next conference coming up. NAAIM Uncommon Knowledge is what they call it. It's going to be in May. It's on our website. If you go to NAAIM.org, NAAIM.org, you can find the details on that. Great conferences, a ton of stuff to learn. There's so many people that say, as long as I keep learning stuff and I get value out of this, I'll keep coming back, and they've been coming back for years. So look forward to seeing you at more conferences, John, and anyone out there that's thinking about getting involved. I'd do it. Love to see you there.
Hey, thanks for having me on the show, Branden, and I hope to see you soon.
Absolutely, John. And anyone that wants to know more, they can go to ProfitScoreIndex.com, I believe. Is that right, John?
Yeah, they can find more about it. Yep, thank you.
Awesome. Okay. See you guys next week.
See you, Branden.